Hey, awesome. Thank you for being here today. Welcome to NAAIM Confidential, episode 14. I'm this week's host, Ryan Redfern. Today we have John Rothe, CMT from Riverbend Investment Management. Super awesome guy. John is definitely one of my favorite followers or follows on Twitter. Big user of RRG charts, big chart nerd just like me, and has done some fantastic research papers. You definitely want to check out. But I thought he'd be a fantastic addition to this program. So we're going to dive into the NAIM index and talk about some of John's processes of investing and just the whole thing that we normally do. So, John, do you have the sentiment index you can bring up for us?
I do. Let me share my screen here.
Fantastic, fantastic. Yeah, the number came down quite a bit after a couple of weeks ago. We hit not an all-time high, but a very high number that was getting some attention from several other newsletter sources. So I thought it was funny, but we've really dropped off here suddenly. And I know personally, I reported 80 this week and actually have gone lower since then. I'm curious, John, where did
I've
you
gone a
report
lot.
this week?
I've gone a lot lower. I think I was about 75, 80 as well. And I've just been, I put sell stops on a lot of things, and they've just
Sure.
been triggering all week long. So I don't know how much we're in cash right now. I think we're about like 10%, or excuse me, I think we're about like 80 or 90% in cash right now. So it really went from one side of the spectrum to the other.
It goes quick, and this one really looks more real than it did the last few little fake sell-offs we had this year. This one feels a little like there's a little more something behind it.
Yeah, and it's funny. I think you and I have talked about it before, where it looked like earlier this year that there was really going to be the start of some type of downtrend, especially as we saw some of the
Mhm.
divergences in the indexes,
Yeah,
and then nothing happened. And now all of a
yeah,
sudden it looked like, historically April's the strongest month for the Dow, and that it looked like it was going to be a great month. And then now it seems like it's quickly turning around.
for sure, for sure. It's definitely different. Well, I know you have some charts. We're going to talk about your process, and I believe your first one has to do with the name exposure index,
It
which I thought was
does.
very, very cool.
So what I like to do with the name index is put it on a point and figure chart. And for people who aren't familiar with point figure charts, they're basically a way to help visualize the trends in the market. And they're really just based on price movement. That they take out the idea of time, so it takes away a lot of the noise within the market and really lets you examine the trends. Tom Dorsey over at Dorsey Wright really popularized these back in the 90s, and he used to describe it as basically looking at like a football field where your X's are you're on offense and your O's are on defense. And what I found interesting is that really, if we look at April 3rd, the index went on defense. So indicating that a lot of members were quickly changing their position. And if we go over here and look at the VIX, this is April 3rd and this is midday today. And you can see it really just picked up ahead of some of this. A lot of the money managers within NAIM really picked up what was about to happen, and it seemed like there was a little bit more nervousness around some of the repricing of equities, as this idea of maybe some of the interest rate cuts not coming to fruition as expected seems to be now finally affecting the market.
Absolutely, absolutely. And that 16 level tends to be a key one. I know Rob Hanna, another name member from Quantifiable Edges, kind of uses that as a key factor. Being above 16 is a higher volatility market, so there's more risk of something going wrong in this area for sure.
Mhm.
Nice, nice. Well, do you have more on the process that you want to go through
Yeah,
on,
sure.
on how you
So,
look at investments
uh,
and charts?
yeah. So my process is basically focused on relative strength and momentum, and then putting a risk overlay on top of that. And the process is basically really focused on this idea of relative strength. And again, that goes back to really the mid 90s, where I learned kind of the Dorsey Wright system. And a lot of it was just based on relative strength. And what is interesting with relative strength is it's a great indicator in hindsight. You typically will see charts like this where somebody will look at a chart like this and say, "Oh yeah, if we were trying to figure out back here if we should be invested overseas or U.S. based, you might look at a chart like this and say, "Oh look, it's obvious. There's rising relative strength here that's favoring the U.S. market over the international markets, and you can see the difference in performance." The problem comes, where does this line actually start? It's a bit subjective. And, depending on, again, where you start that trend, you can be in and out and get whipsawed quite a bit. So, again, these things look great in hindsight, but as a practical everyday tool, it gets a little bit more difficult to look at charts like this. So, what I found very useful are these relative rotation graph charts, which I know, Ryan, you're a big fan of these as well.
Huge
And
fan.
yeah, and what they do is they really help visualize relative strength and momentum within the market. These typically rotate in this clockwise fashion, with this upper quadrant here being the strongest and this lower quadrant being the weakest. I know, Ryan, you've described it as ducks circling the pond. I think that's a
Yep.
great analogy for what's going on here. And we typically like to focus on areas here where you're starting to see strength in momentum, where you go from negative momentum to positive momentum, with the idea is that we want to kind of ride it out as that sector gets stronger and stronger. And it really lets us get in closer to this area here at the start of a trend versus trying to take a look back period and figure out where that relative strength relationship is. So these are really cool because you can really compare them to different indexes. So this is just a sector chart, the major sectors within the S&P 500 compared to the S&P 500 itself, showing basically where the some of the outperformances in some of the various sectors. But I think we both like to use the risk-free rate to compare that
Right.
to show just more of an absolute return type strategy. But you could really go down the rabbit hole with these things. Let's say you wanted to invest in technology, you could compare this to the XLK and then put all the members within that index here to see which areas within the technology
Mhm.
sector are the ones that are leading. So you can, like I said, you can really break it down and go subsector to individual equities and really see that leadership visualized nicely within the market as it starts to progress through that rotation.
Yeah, absolutely. No, I'm a huge fan of using against the risk-free rate, using T-bills or whatnot,
Mhm.
and just seeing where that is, because I find that you can see the whole market, all the sectors move kind of as I say, as ducks around the pond.
Yeah,
You can see when they're moving into improving. When they all do it together, you know something big is coming.
exactly.
It's just a very solid heads up on shift and trend changes in the market. We're seeing a big shift into that lagging box right now as well, with
Mhm.
the exception of energy, even as ugly as it was today.
Yeah, and it's interesting to see, like, you hear the talking points that go on in the market, and it makes you have a very different outlook than what some of the signals sometimes say. And as long as you follow the signals, it's good. But you can see this develop a little bit early, where we'll start to see weakness in a sector, and then maybe a week or two later, it finally hits the media or the Twitter sphere that some of these sectors are really starting to underperform or outperform. And again, it just gives us a very nice heads up and lets us focus on that trend right as it starts to begin.
Yeah, absolutely, absolutely. No, it's one of my favorite things. So I love seeing other people use it as well. And I
Yeah,
know
it's a great tool.
We had Julius DeKempener on our webinar series to teach it,
Mhm.
and I think we're going to probably try to get him back on this summer to do an advanced class in it, because there's so many ways you can take this and interpret data and find things you wouldn't see otherwise. And I just think
Yeah.
that's so cool about it.
Yeah,
It's
and I
like a
think
big
he's
snapshot of everything at once.
yeah, and I think he's such a smart guy that when he talks about it, he assumes everybody knows everything about it. So it's like, oh, just you do this, and it's like, no, no, dive into the math a little bit more. Tell us what your kind of underlying thinking is.
Yep.
So it'd be very cool to really have a really in-depth discussion with him, kind of on the more advanced level, to see
Mhm.
what his process really has been and what finds that works well and what doesn't work. But I know Matthew over at Optimus Software has done a couple papers as well on this, just showing
Oh yeah.
where some of the trends have focused on and how often these sectors rotate and where some of that strength lie.
Yeah, Matthew's done amazing work as well.
Yeah, another smart guy.
For sure, for sure. Cool. Well, what else you got?
So I wanted to test this out to see what really happens when we go from the lagging into the improving quadrant. And what I did is I did a signal test where I took all the members of the S&P 500 going back to 2000 and said, what happens when we cross from lagging to improving, and what happens over the next 160 days. And you can see it does generate some alpha, significant alpha over the S&P 500, because you are, again, investing in strength, investing in areas that are performing stronger than the market. But when you start to do some of these signal tests, you can really see how powerful the relative rotation graphs can be, because you just see this impressive outperformance start appearing over time. And again, this is just something that I've really found useful, because it really puts you on the right side of the market and make sure you're focusing on the areas that are strongest within the market and really avoiding a lot of those non-leadership names. So this has just been, an interesting signal to test and play with over time because, again, it seems like it consistently is just showing that this idea of switching from negative to positive momentum, just in itself, without looking at angles or or the strength of the move or anything else, really provides an interesting outperformance.
Oh, that's neat. Is
Yeah.
this signal using any the list of funds or stocks REIT versus the risk-free rate or against the S&P?
So this is against the S&P itself. And it's basically in Optima, you can go and select the historical membership of the S&P 500. So you get the actual companies that existed within the index at the time. And yeah, so it's just compared to the S&P 500 and just showing again that outperformance. Um, so yeah, very, very a powerful concept.
It is. It is. The data proves it. I love
Yeah.
that. It's
Yeah.
I've not looked at it in this way. That's fantastic. You
Yeah.
always take this stuff a step further than I do, and I love that.
Yeah, it's like I said, it's interesting to test this stuff and see how well it works because in theory it should work well, but then when you actually put the test in place, you see that what the numbers really show, and it's really neat to see this play out the way it does.
Yeah. Yeah. And
Um,
that's really about the move from weakening to improving, not into leading, is where the magic really happens.
that's what I've noticed. I've seen some other people have said that you can really get some value opportunities by focusing on here and playing with the angles and
Yes.
changing the velocity and things like that. And I just try to keep it simple. I find when you start getting into too many details within a trading system, you're starting to over optimize it, and that's where you start to run into problems. So I like to kind of keep it as simple as possible so we don't run into those type of errors.
Perfect. Perfect. No, good information.
Yeah. The other part of our strategy is I like to focus on risk management. So basically, it's what happens when these signals are incorrect or quickly reverse back. Um, we've probably all seen this chart a million times where we know that how long it takes to gain back some of these losses. 2007, 2009 was a great example. It took nearly a decade to recover from this type of loss. So ideally, as money managers, we want to prevent these type of losses within our portfolio and limit some of that downtrend. What's neat is when you look at some of the studies out there, this is from State Street Global Advisors, and they basically created a hypothetical portfolio that said, what happens if you are able to capture just 80% of the upside, but you're also limiting yourself to 60% of the downside? So basically, it means is you're never going to outperform the market on a monthly basis ever, but you are limiting your downside. And the purpose of this was to show how important it is to manage risk within a portfolio. It might even be one of the most important factors because you can see here just the outperformance of that portfolio versus the Dow Jones over time by simply controlling risk. Again, this never outperforms the portfolio never outperforms the market, but again, long term, it's outperforming because you don't have these long recovery periods where you're just getting to break even. So if you can limit those recovery periods and really take advantage of protecting the portfolio on the downside, it really can have a significant impact on the upside of the portfolio, especially when you start looking at market cycles and longer term trends.
Oh, absolutely. And that's one of the hard things to get clients and investors to really understand is that outperformance comes from the not losing, not by
Mhm.
outperforming on the upside. It's I want to outperform when things are falling apart. And that's
Exactly.
what makes all the difference. It really does. And that's how the math works out. So
Yeah.
that when
And it
you're
lets you
being
sleep
active,
so much better at night too when you're not
oh, it
watching things
does.
collapse 10, 15, 20% overnight. I mean,
Yeah.
it's a much nicer feeling as a money manager.
Right.
Um,
There was a quote on a podcast that I love that was saying it's much easier to handle market drawdowns from the sidelines.
exactly. So again, I like to test everything, obviously, and throughout the years, and just kind of reading up on a lot of the academic research, I've noticed there's a trend where if you start looking at the volatility within an individual component, like a stock, for example, as that volatility within that stock starts to reach a certain threshold, usually it's 2 to 3 times the standard deviation of its normal volatility level, it can indicate a reversal in trend. So what I did again, I ran these tests where I wanted to see what happens when you reach a threshold. In this case, it's 2.5 times the standard deviation of the average true range over the previous 2 weeks. And you can see here that the probability of a gain after that happens significantly drops down. You start declining, and that if you average that out as annualized return, it's horrible. But just seeing the probability of the gains drop significantly in this type of environment can provide a good sell signal to prevent some of those losses in with the portfolio. It's not a perfect signal; works most of the time. Again, there's no perfect signals out there, but I'd rather miss out on 1 or 2% of the upside to avoid those quick 5-10% drops that can happen in a very volatile market.
Wow. So based on this signal, have you seen anything this week that gave you a heads up about what was happening?
I have we were kind of getting out of some positions last week as they were triggered, like some of the financials, for example. This week we saw getting out some of the bid caps earlier this week. So it's been just again preventing some of those greater gains, and I'll keep a spreadsheet where I see basically where that trailing stop loss is versus what the price is currently. And I mean, it's kept about protected us from about 5% drawdown this basically the last 2 weeks, just in some of those areas that we were invested in. So
Oh, wow.
I find it definitely works. Like I said, sometimes you do get those false signals, and clients will say, "Why did we buy this?" and then sell it 2 days later and then buy it back again. It's
Yeah.
like, well, you have to explain the process, and it's about risk management. But it's
Yep.
and again, once they start seeing these bad markets, they really start to understand the process and why it's so important.
No, absolutely. Absolutely. That is a neat angle that I've not really thought of. Something I'm gonna have
Yeah,
to explore.
it's surprising again how it when you start testing these things, what really starts to emerge. And this is kind of what it looks like
Hmm.
in practice. This is just a volatility trading trailing stop. So basically, as the price goes up, the trailing stop adjusts. So you're always in that side of the trend. But as that volatility increases, like for example, this is Google. We can see back in late and mid 2020, you had that volatility start to increase, and it really protected the portfolio from that larger decline that we saw during COVID. Because again, volatility starts to represent what the market is feeling as emotion, and it represents that fear that's in there. And we tend to focus, I think, too much on these idea of numbers like PE ratios, growth earnings, and things of that nature. And at the top and the bottoms, people don't pay attention to that. They get scared or they get greedy, and these type of signals get picked up by these type of volatility trailing stops because emotion kicks in and logic starts to get thrown out the window. So again, another very very useful tool I've used to manage risk. Like I said, it's not 100% perfect. This is a great example of it where we had a bit of a false signal here. But like I said, I'd rather deal with this to avoid this.
Absolutely. And you wrote a paper on this specifically.
I did. I have a white paper on the website that examines both taking a slide on both the upside and the downside of this. And again, when we tested against the S&P 500, it really just shows how well it does keeping you on one side of the trend.
Right, right, absolutely. And the paper was a while ago. Have you done updates or continued the
I
forward testing
haven't.
of it?
It's something on my to-do list. It's
Gotcha.
probably 153 down on that to-do list.
Oh no, I totally get it. I was just curious because it's
But
always interesting to see, you have a great premise and then how does it work over the next 5 years, 10 years? And
exactly, yeah,
see,
and it's
yeah,
something I'd like to update over time, but I haven't had time to do it yet.
perfect. Gotcha. Gotcha.
And then I know you kind of wanted to touch base on outlook a little bit as well, how
Absolutely. Yeah.
what we're seeing in the market. I think the big theme that's starting to catch up with the market right now is this idea that the Fed's potentially not going to cut rates at all this year. And as we started off this year, it looked like maybe there were 6, even 7 rate cuts, and that really started looking like that was going to happen in the late fall of last year, and the market really started to ramp up. What's interesting is if you look at the bond market, around January, the bond market started to seem like it was starting, the yields were starting to creep up, and it seemed like maybe they were starting to see this idea that, hey, inflation's getting a little sticky, the economy's still fairly strong, and there's no reason for the Fed to cut rates at this point. And that theme has continued on here, and we can see just looking at the Fed Watch tool what the probabilities of interest rates look like at the end of the year. This is just from a month ago, and we see this continued shift down here in what the expectation of possible rates are. And if you bring this out to 3 months ago, you can really see it really just drop down significantly. And again, now you're talking about, Fed seems like they're hinting at this possibility that maybe there's going to be no rate cuts. I mean, it almost seems like they're trying to slowly prep the market for this idea by dropping hints here and there as different Fed members speak. So that's something I think the market hasn't really priced in just yet. And now it seems like maybe that's what they're starting to wake up to, is this reality of, hey, this recent drive was with this idea that rates were really going to be cut aggressively, and now they're not. We're starting to see strength in the U.S. dollar. We have rising rates come back in. Mortgage rates are starting to spike up again. And those are all things that can negatively impact the market over time. And like I said, I think we're going through this repricing cycle right now that's going to impact the market. And investors don't seem like they're really fully aware yet. And that's where we might get a quick drop down as people start to realize, like, oh boy, here we go. And, for those investors that have substantial gains in stocks like NVIDIA, they definitely don't want to be the last ones out the door. So you could see, again, these things come down very, very quickly if this trend continues.
Yeah, and I remember at the turn of this year, I mean, people were saying 5, 6, 7 rate cuts this year. And I remember one of the few that didn't was I think Jim Bianco. He was saying maybe it's just 2. And I was like, at the time I was like, are you sure? I mean, he seems to know what's going on, but I think he was right there. And at this point, there might be no cuts. There might even be a raise, possibly. I don't think it's likely, but I don't
It's
know.
creeping in there. That idea that there is in there. I think you have a couple more bad data points. It's a possibility, and the oil prices are starting to kick up. A lot of commodities are starting to rise again. So there is that possibility that maybe they do at least float that rate, and that idea of floating that rate. And I don't want to be a conspiracy theorist, but you have an election coming up here, and you kind of wonder, when the Fed has a mandate to control inflation, if they look at things like this and look at the two policies between the two candidates and say, well, we're going to favor this one over this one to help us use to fight this off, and what side they're going to take. Are they going to throw one more cut in, or are they going to raise? So it'll be interesting to see what happens as this economic data starts to continue going down the road.
Oh, for sure, for sure. But we get a rising dollar and a falling market. That's also not good for re-election period. It's there's a lot of interesting landmines that are. I'm curious to see how this all plays out going into the election, because there's a lot of things, a lot of moving parts that could, this could be bad or this could be worse, or I don't know which one's going to be the problem.
Yeah, and it almost seems like we're getting to that point where something might break. I mean, I know credit card delinquencies are starting to go way up again, and it seems like there's, underlying the consumer seems like it's getting weaker and weaker, while some of those job numbers still seem strong. It seems like maybe the consumers start to run out of cash a little bit here, which, again, what happens when they start to miss payments? What happens when they start sending their car back that has this ridiculous rate that they just bought their car at? I mean, I see all the times on some of these social media sites where these people that don't really have the jobs to afford this have $1,200 payments on their car, and it's like, how are you doing this? And at some point, again, it's kind of seems like we're heading down that road right now.
No, it certainly does in a lot of ways. A lot of similarities to 2008 and the 1990 problem as well. We've got this buildup of issues, but you never know which way one is going to play it out, or which one's going to be the trigger, the match that lights the fire. So we'll see. But there's a lot out there that could go wrong again. As we saw,
And I think that's where technical analysis really shines, because it picks up on that fear very quickly, and you don't have the same cycles of people coming out saying, oh, just buy and hold, it's only going to go down 10-20%, just hang on, it'll be fine. And then it takes you 10-15 years to recover. It's not a good strategy.
That's not a good strategy.
And I think people got spoiled by COVID, where the markets came up really, really quick, and they look at these drops as, oh, it can just come back very quickly. But Japan's a great example. It took 35 plus years to break even. It doesn't just happen in third world countries. It happens in major economies where you can have these long underwater cycles that you just need to avoid to make any money whatsoever in the markets.
Absolutely. So what's this RRG chart we have?
So this is an RRG chart from 2 days ago, and it's just the major indexes. And I just kind of wanted to show how it's picked up, again, what's going on in the market. You can see it went from basically the strongest quadrant, and it continues to get weaker and weaker and weaker. And then also, you look at emerging markets. Emerging markets typically do good with a strong dollar. And that's what you're seeing right now. You're seeing strengthening the dollar. You see this emerging markets going up, but the rest, everything is just really starting to sell off. And again, I think the last 2 days might have been a bit of a surprise for some people, but if you look at charts like this, you can would have seen this move really come into
Mhm.
play just before that, and you can. It's just again a great visualization of this weakness that can occur within the market, and it picks up on that trend very early as you see that rotation come into play.
It has. And what's interesting to me is I've been wanting to short the Dow for quite some time, and it's the one that's almost furthest along to that lagging box down there.
Yeah, yeah,
It's kind of leading the way for whatever reason. It's not usually the case, but it's
yeah. And
certainly been on
again,
my radar
remember,
to,
yeah, and
sorry?
if you look at the historical trends, the Dow typically April is the strongest month of the year for the Dow, and hasn't happened. So it's and so we've had the exact opposite.
Yeah.
It's yeah,
Well, I mean, possibly we've already seen the run up that we were going to get in April. We saw it in February, March, maybe we're done, and maybe we're just ahead of the schedule.
yeah. We might there might be some front running coming in here. It seems like that's been happening in the last year or two, where they say, oh, the seasonal trends are going to start at this time, and they start a month earlier. So
Yeah,
there's
yeah,
definitely, I think, people that are examining these historical trends and positioning beforehand. And it seems like just maybe more and more people are doing that to try to get ahead of what's going on within the market. And like you said, it's maybe we've already had that run up, and now it's time to start breaking down a little bit.
yeah, for sure. What else we got? Well, cool. I know we talked about seasonality, but I don't think you have a chart for that specifically, do
I
you?
I don't. I wish I did, but I I just didn't. For some reason, I didn't think about putting one up here. But yeah,
No, no, that's fine. I know that's another thing that you and I both really focus on. There's a lot to be gained by understanding seasonality, and when seasonality matches the trends and the RGs, it's like, oh, it's beautiful.
it's
It's so
beautiful.
good.
It's amazing how well it works together when
Yeah,
that seasonality kicks in. It's just almost like a perfect roadmap for what's about to happen. But then it either works perfectly or it just fails perfectly.
exactly. But I think both of us being CMTs, you know that we've kind of know that you got to take a trend thing piece and a seasonality piece, multiple pieces, and that's really where you get the good stuff, not just
Yeah,
looking at
yeah,
5 ways of trend. So
exactly.
I like
Yeah.
it. Well, nice. Well, then do you have a investment quote? Is that what's up next?
I
Awesome.
do. So my favorite quote's always been the four most dangerous words is this time is different. And I've heard that multiple times. I remember in the 90s when the tech boom was happening and
Mhm.
people were saying, oh, no one's going to overown value stocks. The internet's going to keep fueling this tech growth. And, people say, I remember major research firms. I was at Morgan Stanley at the time. They were coming out saying this time's different.
Yeah.
And again, it blew up we had the housing market going up where everybody was buying houses and so oh, this time's different. And again, it fails. So it's just something that you hear over and over again. And it's just something to be aware of because it seems like there is never a time that it's different.
That's a great quote. That's a great
Yeah.
quote. And I love how every person that we've had on this podcast so far has had a different quote. So
Yeah. Yeah. I'm
I find that
surprised.
impressive.
Yeah. I thought this was going to be the most commonly used quote.
Uh-huh. That no,
Oh,
you did it first. You
yeah,
won.
that's good.
Well, awesome. We're just about at time. So do you have a slide on how somebody can get in contact with you?
Yeah.
There you
Yeah.
go,
I'm
John.
always happy
Yeah,
to chat. Best way is shoot me an email at john.rothe@riverbendinvestments.com. I
cool.
have a separate blog at john.rothe where I put a little bit more technical things in there, just things that I find interesting. I'm on Twitter/X, whatever you want to call it nowadays, at John Rothe.
Yep.
And you can go to my website at riverbendinvestments.com to see kind of the bigger picture stuff and I have a weekly research newsletter I send out with a video every week, and you can sign up there, and I can send it out to you if you guys want to read it.
Perfect. I watch your video almost every week if I can, and it really I love how you cover a lot of this stuff, where we are on the RRD charts, where we are on the interest rate cycles, and where the Fed might be. It's a really good, quick, 8 to 10 minutes that gives you a really good understanding of where things are right now, and
Yeah.
it's
I
very
try to
valuable
keep it
stuff.
short.
Yeah, no, same with me. Well, perfect. Well, thank you so much for being on the show, John. It's
Oh,
great
thank you for
great
having
to
me.
talk to you. Great to spend some time with you. So uh, until next time, we'll see you. All right. For those who NAIM members, we got the NAIM Uncommon Knowledge Conference coming up on April 28th to May 1st. I believe John is sadly unable to do it, be there, but I will. So certainly come by and say hey. And we'll see you next week. Thanks for being here.
Yeah,
All right.
thanks, Ryan.